What's up, everybody? Welcome back to Taxes Made Simple. I'm your host, Karlton Dennis, and in today's video, I'm going to teach you how to avoid taxes before the end of the year with rental real estate investing. I'm sitting on about 27 different doors right now between my syndication that I run and the real estate that I own with my wife, and this real estate directly helps us offset our taxes. So what I want to do is I want to teach you how to find the right type of real estate, what you need to do between now and the end of the year, because you have about 4.5 months to find your property that can help you offset your taxes. Without further ado, let's dive in. All right, guys, welcome to the channel. If you're new here, what I want you to do is subscribe right now. We are posting tax strategy content every single week, and you're gonna wanna make sure that you're locked in with us. That being said, I invest in real estate with my clients, and I strategically help them find rental properties to reduce their tax bill. There are 8 key steps that you need to conquer before the end of the year in order to offset your taxes with rentals, and we're gonna discuss them. Step number 1, finding a rental property. Now, before you go out there and start shopping online for real estate, you first need to understand what your real estate strategy is going to be. Are you going to do the short-term rental strategy? It's nice. Only 100 hours. You have to spend more time than any other person in this, and you have to rent out the property for 7 days or less. Or are you going to do multifamily or long-term real estate investing? One thing I love about long-term real estate investing is you only have one tenant staying for 12 months at a time, or a couple of tenants staying for 12 months at a time. You don't have to worry about constant tenants coming in and out of the property, and maybe you're only signing one lease. You don't have to list the property on Airbnb, VRBO. But the difference is you have to spend 750 hours, and you have to show the IRS that you're spending more time in real estate than any other thing. So the first thing we have to do is figure out what type of strategy we're going to work with. Are we going to work with the short-term rental strategy, or are we going to work with the real estate professional strategy? Because that can determine whether or not we go into long-term rentals or short-term rentals. Now that we've determined which strategy that we're going to do when it comes to buying real estate, we next have to figure out the building to land ratio that we need. Anytime that you buy real estate, you're buying 2 different things. You're buying the building and you're buying the land that the building sits on top of. Unfortunately, the IRS only gives you a tax write-off for the building's amount, not the land. So if you buy real estate here in California, unfortunately, it's going to be high land value, very low building value. So you're not going to get a whole lot of tax write-offs here in California for buying investment real estate. But when you go outside of California to places like Arizona, Nevada, Texas, Florida, you start to realize that the building value is much greater than the land value. And in our office, our rule of thumb is that we want the building value to be at least 80% and the land value to be 20% or less. That way we know we're getting the most amount of depreciation possible. Once you have figured out a property that you like that fits your budget, that has 80% building value to 20% land ratio, the next thing that you want to do is you're going to want to do a cost segregation study estimate. What is it? A cost segregation study estimate is where you plug in the property's details, such as the square footage of the property, the year the property was built, some of the appliances that are inside of the property, and you can figure out how much depreciation that you're able to receive in the first year of ownership of having this property. In case you're interested in figuring out how to calculate this, I have provided a link to my website below where you can go and click on Cost Segregation Study Calculator directly on our website and input your property's details to figure out how much depreciation you would receive in year 1 of owning a property. But once you have this amount, you now know how much depreciation you're able to receive in the first year of owning this investment property. The very next step that we have to execute is going into escrow. Going into escrow requires you to get a mortgage, and it requires you to go through the underwriting process. Karlton, what's the underwriting process? It's essentially a financial analysis to determine your credit worthiness to receive a loan. The lender is going to look at your credit history report. The lender is going to look at how many loans you've ever taken out in your name. They're going to look at what income you bring in every single month, and they're going to want to know what expenses work against your income, so they may request your bank statements. But by going through the underwriting process, you can ensure that you can close escrow hopefully within a 30-day period, and that way you can get the property ready before the end of the year. The next thing that you have to do is you're going to have to set up an LLC. The reason why I want you to set up an LLC is because if you're somebody that's like me and you care about anonymity and keeping your name and information offline, what you're going to do is set up an LLC, and right before you close escrow, you're going to have the title and escrow company title the property in the name of the LLC. I like to name LLCs after the property's address. Maybe it's 1234 Johnson Street. I'm gonna name the LLC 1234 Johnson Street LLC. I like to make sure that my LLCs are organized and that I have them separated based off of the properties that are gonna be held inside of them. That being said, if you're setting up a new LLC, be sure to do two things. Number one, create a virtual address. You can go to northwestregisteredagent.com and create a virtual address through their site, or find another website that sets up virtual addresses. And step number two, choose a registered agent other than yourself. I've made this mistake before when I was 20 years old, setting up my own business, registering myself as the registered agent. I highly recommend that you don't do that. This keeps all of your name and information from being online. Now that you've found the property, you've determined your strategy, short-term or long-term, you are able to close escrow and you set up an LLC, the next step that you need to take is to list your property online for rent and log your hours. This part right here is how you ensure that you're running a rental business between now and the end of the year. You have to have fair rental days, and you need to log your real estate professional hours or your material participation hours. If you need help logging your material participation hours, or if you would need advice on what hours that count, you can go ahead and visit the link below to grab my real estate professional log booklet, as well as join our Tax Strategy Accelerator community. We post educational material there all the time on how to garner your material participation hours. But now you're in position to save money on taxes. Now it's finally time to rent out the property. But how do you make sure that you actually get the tax savings that you want after you've done the cost segregation study analysis? Now you have to pay a tax professional company or a cost segregation study company to execute the cost segregation study for you. This is the final step. On average, cost segregation studies are around $1,500 upwards to $7,000, depending on how big your property is. I rarely see cost segregation studies crossing that $10,000 mark, but the ROI is always 200, 500% when you're doing these cost segregation studies. So don't be alarmed about the price. You're normally always saving much more than what you would have paid. That being said, the cost segregation study is also a write-off. You will be able to deduct that on your tax returns. And this is how many taxpayers are able to reduce their tax bill between now and the end of the year. They buy real estate, they make sure they're buying the right type of real estate, they make sure they can use the losses, they make sure they perform the cost seg, and they make sure everything is being done in the name of an LLC. If you're watching this right now and you need help finding that property, you would rather have somebody else help you set up the LLC, and maybe you even need someone to help you perform the cost segregation study, we would be happy to help you with all three of these steps here at Tax Alchemy. Our company primarily focuses with real estate investors on helping them acquire real estate, set up their investment properties, close escrow, do the cost segregation study, and make sure all the strategies get included inside of your tax return. If you would like to take the next step, go ahead and visit our links below. If nothing else, I hope that you love this video. Do something for me. Like, comment, subscribe. Let me know what you think about this video and if you're going to be buying real estate between now and the end of the year. I know that I am. It's one of the ways in which me and my wife offset our taxes, and we'll be doing so for the foreseeable future. My name is Karlton Dennis. Thank you so much for joining me on this video. I look forward to seeing you on the next one. Cheers.